In this video, I would like to share with you the process that I use when I analyze new stocks. I have been investing for over 12 years before I went to college. Then I got my bachelor degree, my master's degree. I was working as a software developer, and several major projects were in personal finance and in investing. So investing was a major passion for me. And in this video, I will guide you through the process that I use, which I call 4P, which allows us to construct the company profile, to understand the company prospects, and to understand what price we are willing to pay for the stock. So let's get started. First of all, if you are not subscribed to the channel, you can do this by pressing this red button. You will not miss a single episode, and it's absolutely free. If you haven't been investing before, a good place to start is the book Why Stocks Go Up and Down. It has overview of many concepts. You will learn to read financial statements, and you will have a basic understanding of how to value stocks. So I highly recommend as an overall view book. Okay, this is the process which I call the 4P, and I will guide you through each step. The first P stands for personal. You must have a personal connection with the company. You can be a client or a customer. Your work may be related to the company, or you can have a major hobby that is related to the company. Why is this important? Because if you're a customer of the company, you can spot trends early on that are not reflected in the financial statements. If you already know the company, you will have a substantial edge over other investors. This is what Peter Lynch wrote about in his book Beating the Streets. There are a lot of doctors that are investing in oil stocks, and specialists in oil industry invest in pharmaceutical companies, than doctors that are investing in their own stocks. If you already know a lot about the company, you will have a substantial edge, and this is very important. The other thing is that it will be much more interesting to research a company that you are already familiar with. It is much easier to add to existing knowledge than to form a completely new one. So if it's a completely new industry for you, this may be a little more complicated for you. So it is much more easier to already know a lot about the stock. Okay, the next P stands for profile. In this step, we're trying to understand the company. We're making the qualitatively analysis of the company. We need to understand the basic info, how the company makes money, what is the market cap, how many employees does the company has, what are the key markets, what are the key sources of sales. You can find this in 10K report. You can download the 10K from the official website of the company, or you can go to sec.gov and download it from there. So I believe the most important section in 10K are the business overview section, the risk section, and the management discussion analysis section. For example, for Facebook, if you understand the risk section, it is clear why the stock dropped so much in the recent quarter. The two risks materialized. First is the growth risk, and the second one is less effective AD targeting. So these were the main risks that were outlined in this section. So it's extremely important to understand this exact section. The company is obligated to list its main risks. The other key point is management. What I like to see is that CEO has a substantial track record and that he has substantial stock position. So he treats his company not like a hired gun, but like a part owner of the company. Understanding the risks of the company, understanding the key markets, the key sources of sales, you can understand the key drivers of the stock. So this is very important to understand what drives the stock price. Okay, the next P stands for prospects. If the previous step was all about qualitatively analyzing the company, this step is all about quantitatively analyzing the company. The first step is the moat. How hard it is for competitors to get the market share from the company. This is what Pat Dorsey wrote a lot about. I believe the great place to look at is the return on equity. So what is a return on equity? You get the total net income divided by equity. Equity is total assets minus total liabilities. You can look for this number using services like Yahoo Finance, or you can calculate it from the 10K. I like to see this number at least more than 20. Then what I like to see is the company is stable. What I mean by that is that it has manageable amount of debt. I like to see that the net debt is no more than 4 times free cash flow. The other thing is that if you're buying the company for the dividend, what I like to see is the payout ratio is not more than 60%. Payout ratio is the amount of net income that is paid to shareholders in the form of dividend. Usually when the company lowers its dividend, the stock can go much lower. The next important thing is growth. What I like to see is that revenue growth for the last 5 years is more than 10%, so it's a top line number. The next thing is the book value per share growth. According to Warren Buffett, book value per share is a great indicator of the future price performance. Okay, we have constructed the company profile, we understand it well, we understand the company prospects, we know that the company is stable, we know that the company has a moat, we know that the company growth is substantial. Now we need to determine what price we're willing to pay for the company. It is really dependent on the type of the company you're analyzing, to what valuation methods to use. I will list my favorite methods. You can look at the average price to earnings chart for the last, for example, 5 years, and only buy the stock when the price to earnings is low. This is good for well-established large cap stocks. The other method that I like to use is discounted free cash flow or discounted earnings per share method. I will link at the end of the video the step-by-step tutorial on discounted earnings method that I use. Book value per share is a great predictor for financial stocks. You can use valuation methods, for example, like EV to EBITDA. EV stands for enterprise value, EBITDA stands for earnings before interest and tax, depreciation, amortization. According to book What Works on Wall Street, EV to EBITDA was a great predictor of the stock performance. Also, a lot of value can be unlocked in spin-offs and mergers and acquisitions. This is something Greenblatt wrote a lot about. So when a spin-off happens, usually the company has a great balance sheet and a lot of value can be unlocked in the process. I have made an analysis of Discovery Communications merger with Warner Media. I will link to the video in the end. Also, I believe a very important step is to see whether gurus are buying the same stock that you are analyzing. And if yes, at what price? You can check if world-known famous investors with great track record are buying the same stock that you are analyzing. So I believe that this is a very useful information. We have valued the company. Now we need to determine what margin of safety to use. The more confident you are in your analysis, the less margin of safety you can use, for example 10%. But on the other hand, if the company growth prospects can be on the high end or can be in the low end, it's very hard to determine. You can use a larger margin of safety. Also, it's about your personal preferences and your risk tolerance. We have covered the 4P method. First, it allows you to understand the company on a personal level. It allows you to construct the company profile. It allows you to understand the prospects of the company and to determine at what price the company is interesting to you. Please write in the comments below about what companies would you like to make an analysis. If you haven't subscribed to the channel, you can do this by pressing this button. You will not miss a single video. Thank you very much for watching till the end and see you in the next video.